might as well just start with a little bit of heat. Might as well, and kind of look at like what I look at, what I'm paying attention to, as far as swing trading, as far as futures trading, as far as anything in the market. So the cool part about kind of learning this price action from a higher time frame, it opens up a lot of possibilities for what you can do. So most people kind of think, well, yeah, I can, you can buy elite, or you can day trade, or you can day trade futures, day trade options, et cetera, et cetera. But the cool part about kind of learning what the algorithm's actually doing and what this actually means, then you can really actually start honing in of saying, hey, I think the market's going to drop based on X. From there, I can extrapolate that and say, well, if the S&P 500 is part of the ES, then the top 5 holdings are going to drop as well because it can't go up without them. So Apple, Google, Amazon, Microsoft, etc. Like these companies are going to start dropping. So if I know the SPY is doing it, I can play protection against my leaps. I can play puts or inverse calls, SQQQ, SPXU. I know exactly when it's going to retrace back. I can literally catch it at the discount, bring it all the way down, and have a target. And so therefore I can short the market, short SPY, play inverse calls, short Apple, Amazon, Google, etc. So knowing this small little thing can actually, I mean, everyone says walk to freedom, but I mean, if you walk into something cool, but at least hopefully you're moving. So main thing that I'm trying to look for here is presenting like, what is the market trying to do? So the reason I have it all black is because I don't care about bullish and bearish candles. Like if you really want to like work on price action, forget the colors, because at a certain point, it's either going higher or lower. It either closed higher or lower. Whether it's green or red only tells you what the color is. I can change my candles to fuchsia. It doesn't really matter. It's checking out what direction it's going. So in this aspect, what we start to see is the market come up and set an intermediate high. Now, to some, that's equal highs. And what is equal highs typically known as, Lex?
Liquidity, a target, all that.
Exactly. So when the market starts to set equal highs, well, then it's going to leave a space for us to come up and hit. Now, on top of that, the market will start to run up towards that. Now, the cool part about the market running up is it typically leaves a little bit of a space and a reminder of where it wants to try to go. So the key to trading price action is not following the candles and chasing them, is actually looking back and seeing where it came from. And so if I can see where the market came from, I know where it's going to go if it flips. So what you start to see is the market sets equal lows. Now, if equal highs is liquidity, then equal lows is liquidity. So if the market runs up and it doesn't close above the high, that's also known as a stop loss or a stop hunt. Everyone's been in a trade where all of a sudden it wicked down, got you out, you pissed, and it goes in a direction that you already thought it was going. Happens to everybody. So, real traders lose. It's fine. It happens. And so the main thing that we're trying to look for.
Emphasis on real traders take losses.
Oh, Lord.
It doesn't always work, but it works 90% of the time. But it doesn't work all the time.
It's a higher percentage if you stick to higher time frames, yes. So we look at this and we see what is actually the market doing. Well, this wick here is telling us that we don't want to go higher at this point. When we look at price action and liquidity, a closure above highs tells us where we want to go. A retracement below those highs tells us that we don't want to go there yet. It's the same thing depending on who you even like train with. The only way this wick starts to come down like that is people are selling it. The only way the candle comes up, people are buying it. Now, are there really buyers and sellers in the futures market? That's debatable, but at the end of the day, when we're starting to look at this, we start to see this candle push down. And the next week, we started to push down. Now, The cool part about looking at this is we start to see cool. It's cool in hindsight. Everyone can view hindsight. But what we start to see is from this candle, what is the draw on liquidity? Where's more liquidity? Well, your liquidity is going to be found at swing highs, swing lows, relative equal lows, relative equal highs, and gaps or ABC gaps where it's A, B, and C, where A's wick doesn't touch C. So if I'm looking at this, and let's keep it super simple, is there a wick? I mean, is there a gap? Is there equal highs, etc. up here? No. Also, what did the market do before it went down? Well, it closed below, bro, this thing here. It closed below this swing low. So if we just said over here that the market doesn't want to go higher because there's no closure, well, then what does it mean when it closes below a swing low? It means it wants to go lower. So at this point, we're talking about this breaking market structure. So as this breaks market structure, it comes down and starts setting intermediate targets. Every swing low and swing high is a target. And so once we set this up, now we're set to where the market is trying to go lower. Not only is it trying to go lower, it's January in the market. We're talking about inflation. We just hit an all-time high. So if we just hit an all-time high in the S&P 500, there's no liquidity up here. Who's up here? So once we actually make a decision to go down, then this is where we're starting to go. Typically the first quarter is trash. Clearly the second quarter is trash this year, but the first quarter is typically trash, so it's going to trade down. So now everything fits the narrative of having a Christmas rally, having the market run higher, break lower, and we're into January. And the narrative theme and sentiment of the market is bearish, inflation, printing money, et cetera, et cetera, et cetera. So inside of that, now we're in a situation where the market is bearish. Not only is it bearish, it's setting targets in a range. So once we set equal highs, and then we all of a sudden set equal lows, this is our range now on the weekly candles. Now, once the market runs up and all of a sudden it doesn't close above, what's our nearest liquidity? Well, we already hit an all-time high, so there's nothing up here. We already broke market structure lower, so it's telling us we want to go lower. So our next liquidity point is our gap. So if we know that our next liquidity point is our gap, we can target our next point of entry being somewhere in this region down to the gap. So as we kind of go back through the next candle, you can see it retest and then try to start pushing down. Now, as it pushes down, it comes right into the gap. Now, typically it doesn't fill a gap right away. Typically there's one little bounce on the gap and then it retraces and then starts to come down. So we kind of look at that in this instance where a lot of times it hits the gap, tries to retrace back out, but it's typically a fake bounce because we already got confirmation here that we're going lower. So once these things kind of bounce on a gap, we're ready to kind of take this down even lower. So once we kind of get this in a situation where it's pushing lower, now we have our gap filled. So that's our next point of liquidity. So at this point, we have taken liquidity higher, closed below the swing low. Now we're inside of this fancy little yellow box. Now the box doesn't matter at this point, but the equal lows matter. So if that's our next point of liquidity and the market likes to go to the least path of resistance, then this is going to be the area it's trying to go to. So if I can look at this on a chart and the market finishes at 42.66, its next possible target is 41.31. So if I know this going into it, then I can prepare to play this short all the way down to here. So the cool part about knowing where it's potentially going to go, you can know where it came from. This tells me it already took out the stop loss and went down lower. This tells me where liquidity is. This tells me where liquidity was. Does that all make sense so far? I hope so. So from that aspect, now I can target and see if it's coming down lower. Now, the way liquidity works in the market, soon as we break a liquidity level, it reverses. But how it breaks it determines where we go. No closure above it, retrace back down. Closure below, just a retrace, and then we're gonna go lower. So as we start to kind of push into this, we're gonna kind of pay attention to see what it tries to do. Now, at this point, the market has set 3 equal lows, or triple bottoms, as some people call it, support, as other people call it. But the problem with the futures market is it doesn't care about support and resistance. I promise you it doesn't. What it does is it sets this up as a target to come hit. The reason it sets that up as a target to come hit is because if I see this triple bottom, and if I see a double bottom, if someone sees a triple top or double top or whatever, it's a bearish signal, right? So you're going to say, you know what, every time it comes down here, I'm going to buy it up because that's my support. Every time it comes up here, I'm going to sell it because that's my resistance. Well, the market sees that too. It knows exactly what's happening. Who do you think wrote the books you read? So essentially, at that point, it's going to come down and get this, because where are the most traders in this market? They're here shorting and riding a candle down, and they're here waiting to either bring it down lower or try to buy it back up. But either way, they are sitting right here waiting. And so what the market does is it comes down, takes their money, and retraces back up. This move here is probably the most aggravating move in the market, because once it actually takes this liquidity and starts to retrace back up, now other traders are chasing it back up. But little do they know, it's going lower because we already have our keys, right? No liquidity, closed lower, took liquidity, broke lower. So now everything says bearish, and all we're waiting on now is to see, where is the market going to try to go? Now, where is the next place it could go? Well, the next level of liquidity is this swing low here at 40.41. Also, there just so happens to be a gap sitting right here, which is another form of liquidity, right? So if the quarter is bearish, the monthly is bearish, the sentiment is bearish, the news sentiment and thesis of the market is bearish, and we have support by technicals that it's bearish. The news, whatever, that doesn't matter. They play kind of pawns in all of it. But at that point, the market's not going back up at this point. So all it's going to do is retrace higher and entice people back in, and then push lower. So see how it attacks liquidity? It literally attacks this gap and stops. So at this point, what we're waiting on is for the market to set below and push back up. Now, I will give you a break. I will put the colors back on. So, but if you really want to learn price action, make all your candles the same color. I promise it'll train your eyes better. So once this comes down, now we have a reason for the market to come back up. These little gaps in here are actually imbalances in the market. So once these imbalances start to happen and we close below liquidity, that means the next thing that we're waiting on is for this to retrace back into this area. Now, when we're talking about price action and we're talking about trades, well, the best trade I have found is technically called a breaker. I did not invent this. ICT invented it. Won't take credit for something else, but he doesn't talk about it much because it's kind of somewhat of a simple and complex thing, because all of the thesis and the narrative have to match. But the cool part about having a breaker is there's 4 levels of confirmation that have to happen. There has to be an intermediate high set. There has to be an intermediate low set with relative equal bodies. Talk about that later. Stop hunt has to happen. A close below has to happen. If all 4 of these things happen and the narrative is the same, then we can predict with reasonable certainty that when the market starts to retrace, we can do one or two things. We can play the market up to the breaker, which means we can play calls up to the breaker, and then we can get ready and flip it and play short down, because now we have all the confirmation in the world with all of our fundamentals, all of our quantitative analysis, plus our technical. So hopefully everyone's following along with that. And so now we have an intermediate low set. So we call that low hanging fruit. Obviously, if anybody's good at apple picking, literally you pick the lowest apple, you know, if you're lazy. It's usually not the sweetest, but they're the lowest. So at that point, these are the easy targets to hit. So if you see the market start to push back up, this is what you're waiting on. So if it pushes back up, the next target is going to be in our breaker. And once this comes into the breaker, now, I'm not silly enough to say, hey, catch it here, it's never going to come back up. So inside of this range, the market can run from 4,200 to technically 43. But remember when we talk about liquidity, none of this matters until it closes above a level. So it can play around in this range all day. If it doesn't close above these equal highs or inside of this gap, we're coming straight back down. So those are the things that we have to look out for. And that's what we're basically trying to look at. And from a weekly basis, obviously we're looking at our high time frame basis. What does it do? Well, here was our former gap that was there, so it's not there anymore, but it pushes down. Our sentiment is bearish, our low is bearish. To complete this trade, it's going to come down and take out this low, because as we look, the price runs faster away and then it runs faster up. So the faster the price runs down and the faster the price runs up, the more out of balance the market is. So it's going to come back down and feel that imbalance. And so essentially, once that happens, it completes that target. And then we see what the next week brings. And so that's essentially how we trade the market and how we trade breakers. And this is the description of the breaker. And Lex, the floor is yours. We can talk about another chart.